Now, as we turn to segment 3, we wanted to start off with this chart that we had from last week, just looking at the agency outlook. So again, the IEA is showing surplus in 2024. The EIA is showing something similar. And a lot of that is with a little bit of an increase in demand in supply, but realistically, some of the bigger adjustments in demand. And it should be appreciated that a lot of this is, you have to look at what is going to happen with those cuts from Saudi Arabia. Are they going to extend it? We think it's very likely that Q1 is an extension, likely into Q2. But the problem is going to be, what is Russia doing? Is Saudi Arabia willing to take another to keep that million off if Russia's moving higher? They're back to exporting at a 4-month high, which is eliminating, again, some of those cuts that they've talked about. And we want to look at how is that trending. And because of those additional flows, you're seeing some of that pressure in Asia, where they're buying less West African. Now, Europe is buying a lot of Angolan. U.S. is starting to pick up some Nigerian barrels. And then Brazil is, again, benefiting from all of this, given their distillate heavy crudes, which are that medium sweet, which is that perfect kind of crux point. And we do see that coming and increasing in terms of demand, which is keeping that pricing elevated. This is just a snapshot. So French road diesel demand fell in September. As we talk about in the Econ show, the EU is in a recession. So we do see more pressure on demand. We do see more pressure in general on economics footprint. So that's why we don't see a lot of nothing is really going to be a saving grace coming out of Europe. They are going to struggle to source distillate. You still need diesel at this point, but realistically, based on where gasoline is and the other pieces, we do see pressure in the European markets. Refiners in China have taken a lot of Venezuelan oil, but as things escalate in the Middle East, we're going to see more Venezuelan crude coming to market. Exports are going to start increasing this way. We do see about another 500,000 barrels coming into the U.S. From Venezuela, and some of that will come at an expense to China. But again, China is just going to buying a bit more Russian, but they'll buy a little less Venezuelan, and a lot of that will come into the U.S. markets. When you look at the seaborne crude coming from Russia, you can see that on the 4-week side, it's trending higher. Russia oil flows are climbing steadily as Moscow's adherence to a pact with Saudi Arabia is waning. About 3.53 million barrels a day of crude was shipped from Russia's ports in the week of October 22nd, an increase of 20,000 barrels a day over the previous 7. That lifted the 4-week average to 3.5 million, the highest since June, and up about 610,000 barrels a day in the past 2 months. So again, that's a lot of crude when you look at what they've been trying to do. And a lot of this is because they don't have much choice, because they're struggling to bring back their refiners. They're continuing to struggle on the refining front. So they have to do something with that oil. And we've been saying from the beginning, as those refiners don't come back to the same level, it's going to put more crude on the water, and here we are. Exports continue to rise, and you can kind of see that shift in general. And unfortunately for Saudi, and a benefit for the market on the supply side, we don't see that slowing, which is going to strain some of those relations just a bit. When you look at the Dubai hydrocracking margins, you can see it moving lower. There's more and more downside, especially when you look on the gasoline front and the hydrocracking in general. There's the discount of Brent to the Middle East continues to grow, which again is going to cause more slowdown in the Middle East buying. And that's why we're seeing more of those fringe purchases, especially when you look at Brazil, when you look at the U.S. continuing to export, because people are trying to avoid buying, above their term contracts when you look at the Middle East. Now, when you look at flows, this is looking at crude flows coming out of the Middle East. You can see that Saudi had that drop. It's staying within a fairly tight band. So again, that just shows them adhering to the million barrels. You can see Iraq is taking advantage that you're having higher highs, higher lows. They have heavy and medium. So, again, they still increased their OSPs, not to the level that Saudi has. So it gives them the opportunity to cash in a bit. And then we've had a little bit more increase from Kuwait, but again, nothing meaningful as you get some of these flows back and forth. So things are pretty stable. Nigerian barrels for prompt supply have weakened a bit. We have gotten a little bit of an increase in Nigerian buying, which again is just because prices came down a bit, started to see some of that purchasing. There's still less going into the Asian markets just because they have a lot of crude coming in already. They don't need that excess, especially when you look at Russia. So this is looking at Russian flows. You can see the higher highs, higher lows. The trend is up, and we see it continuing to trend higher just because they have to do something with that crude because they don't have the storage, and obviously they don't have the ability to pipe it. Now, when we look at Brazil, that's just gives you an idea of the level of Brazilian exports. Obviously, there's that. Some of that is just timing, but you get an idea. It's just, again, the elevated level. And then Venezuela starting to drift up. We see those two things continuing to be supportive of flows coming into the Atlantic and then, on their way into the U.S. Now, when we look at product here, you can see that the Chinese and Indian exports remain elevated. China continues to drift higher. There's a ton of margin to capture. They still have those export quotas. And realistically, they also front run a bit. And the level of activity right now also supports a fourth quota. I think they wanted to see how demand is shaping up. They had a fairly good September in China, economically speaking. October has been a bit weaker. So I think because they wanted to make sure that they have enough product for the Q4, they have enough product for the start of winter. And as things kind of shift here, we do see things starting to increase. And India, again, continues to push things in general. When you look at the level of discomfort in the market, because, again, when you from discomfort, I just mean in terms of pricing, because right now you have India and China that was buying Russian crude. They were able to crack this product at a pretty decent discount, and now they can sell at current prices, which, even though crack spreads have come down, it's still a great margin for them given where their source crude came from. Now, when we look at flows, gasoline and distillate from the UAE, Saudi, Kuwait, you can see that Saudi and the UAE have trended higher. Kuwait a bit lumpy, but again, that trend continues to go up. Things continue to move higher when we start looking at some of these flows, especially when you look at the UAE and Saudi, again, trying to take advantage. But a lot of this product right now is still going into Asia, but as China and India continue to move through, as demand slows there, we do see some of this turning into the U.S., which is going to keep and essentially support some of that crack spread in the near term when you look at the Asian markets. Now, when we turn to Russian exports of product, you can see it's fallen more. We do see this weakening, and it'll stay. Obviously, they still have the ban. They softened the ban a bit, but it doesn't mean that they have the product to export, which is going to keep that again moving a bit lower. Russian petroleum product exports stumble, hitting that 3-year low, and a lot of that is driven not only just based on the ban, but also just the inability to make the product that they need, given their issues on the refining side. Middle East floating storage trending higher. As we were saying, we expect this to continue to trend up. You have insurance premiums. People are a bit concerned about going near the region at the moment. So we do see that not only pricing, they've priced themselves out. Then you have the concern about geopolitics. So again, we do see that continuing to drift up. When we look at U.S. exports, moving higher, this has us at a four-week rolling average of 4.5. It's closer to 4.3, but again, still remaining very elevated at this point in time. This is looking at the diesel crack spread within Asia. You can see it trending a bit lower. We do think it could come down to about 22. There's a lot of support at 2022, and that's where it, realistically, it should be between 22, 27 and kind of live in this range. And even though we talked about slowing in demand, but we still have a shortage of distillate heavy crudes. All distillate heavy crudes are still trading at a premium. That is, again, going to keep this higher. But then the question is going to come down to, where is gasoline? As gasoline weakens and as gasoline or light distillate storage goes up, it means that they need this to carry the crack spread more. So any softness, especially based on either exports or incoming storage, that's we do see risk to Asian refiners or ex-China when you look at some of these flows, which is why this is going to be an important one to watch. This shows you another steep drop on the swaps between Dubai and Brent. Again, Brent still trading much cheaper than Dubai, which we don't see changing in the near term. Asian floating storage fell again. As we were saying, we do expect this to come up. There has been an increase in buying. Some of this is in front of what we do expect to see for the fourth round of export quotas. So again, we do see that trending back up and sitting between the 2022 and 2021 levels. China supertankers, again, trending higher with 22. And this is why we things are looking very similar when you look at the purchasing side in comparison to last year. And that's why we do see that floating storage continuing to trend up. Shandong independent refiners continue to be fairly flat. A lot of the growth in runs is on the SOE side, which is something that they've built. They've spent a lot of money building them. They're going to continue to bring those online, and that's going to be to the detriment of the Shandong. When you look at driving has slowed down just a bit. Unfortunately, 2022 is a tough comp just because they still had zero COVID policy. You had a lot of lockdowns that happened post Golden Week, but on an economic basis, we do see the trend coming down. But again, it's still going to be better than the strike point of Jan 2021, which is tough just because the comps are always going to be better because we don't have zero COVID policy. COVID is kind of fallen out of the lexicon at this point, and that again is going to put the comps a bit easier. But it's why we try to talk about kind of where things are going on an economic footprint. West Africa had some drops in floating storage, even though it remains at a seasonally adjusted all-time high. A lot of that is because some of the Nigerian cargoes went into motion. We did get some purchases. Angola was able to sell out. A lot of that going into Europe. We did see some slowdowns in Asian purchasing, which is something that we expect to continue, especially as those new Russian barrels come to market. U.S. exports, as we were saying, we expected gasoline to come down, and move closer to the 5-year average. We do expect that to kind of hug the 5-year. Distillate had an increase, but remember last week was too low, so we're kind of coming into where we see some of that fixed point. And a lot of that is just because it was too low, just because you had the exports of crude. So again, that's that timing delay that we talked about. And then propylene had a big spike of 697,000 barrels a day. Again, still elevated, and we're just going to continue to be strong exporting into the market with crude exports still remaining robust. This is just looking at the averages. Again, gasoline exports trending back down. We expect it to hug that 5-year average as the global market, again, continues to be overwhelmed with the amount of gasoline sitting there, which is going to be the problem point when you start looking at crack spreads, because can the diesel crack carry the gasoline crack is going to be a question we're going to ask ourselves constantly through at least the remainder of this year. Distillate, as we said, fell too low. It was going to bounce back up. We do see this staying below the 5-year average, but again, moving a bit back into that bottom end of the cloud. Crude oil exports staying strong. Don't see that changing as we continue to get record-setting propane exports. Again, something that we don't see changing. Then when we look at U.S. ethane exports, seasonally all-time highs, where we're going to have a record. It's because we have new export capacity, new demand from Asia, specifically China. So again, that's going to continue to be robust. Then when we look at Fujairah, so Fujairah technically had a drop. It had a drop of 1.699 million to 16.8 million, but it was all heavy resid. We had a build in light, we had a build in middle, and that's going to be the problem point. Heavy disti and resid is very lumpy, so we do see this coming back. The bigger issues remain on the light distillate and middle distillate side. So light distillate increased 359,000 barrels to 5.826. East of Suez gasoline complex strengthened a bit as participants were expecting Indian gasoline demand to rise as the elections amid the election season. Remember, they're trying to keep subsidies. What happens after election? They get kicked off in October. And so again, additionally, some participants said that the gasoline imports could increase. should prices continue on a downward trend. But again, it's just going to be a matter of setups, because importing gasoline could be cheaper than producing gasoline. And then Australian import demand ahead of summer season. Other market participants caution that they had yet to see a significant uptick in gasoline demand from Australia. So that's going to be important to see how is gasoline setting up. What does ASEAN nations look like? We do see, again, because of the focus on middle distillate, we do see, even if you have some demand in light distillates, they're going to be producing a ton of it. And that's where we do see those builds. Middle distillate rose 508,000 barrels to 2.139. Fundamentals in the east of Suez gas oil market remain unchanged, with traders awaiting, again, the drivers. Gas oil market may be a bit soft now, and winter heating demand has been quiet so far. We don't see that changing really in the near term. Demand for gas oil was expected to remain uneven, just because of where we are. East of Suez is going to be a key point at the moment. A lot of this, especially from Fujairah, was heading into Asia. We do see that pivoting back a bit as those Indian and Chinese barrels come to market, which is going to put a bit more into local storage and then again kick it into the Atlantic basin. Heavy resid decreased 2.566 million barrels to 8.845. Spot trading activity at Singapore and Fujairah was seen busier, but it's been really slow. So again, the stuff's still going to move. Global trade's down 5%. It's not tumbling to a huge low, but again, it's still going to be lumpy. So we do see this coming back in and building back up. Brent time spreads have come down significantly. That's something that we will reverse back up. A lot of this is going to be geopolitical, so we're going to have this gapping around. We do see that one more spike, and then after that, the invasion starts. We do see that drawdown. If Iran really escalates it may stay higher for longer, but we do see the trend inherently bleeding out and coming down. Now, when we look at flows on the global market, Nigeria increased so in November they had 1.4, and so far in December they're saying 1.39. The problem is going to be, are they going to get any of the deferrals? So it could really be that November, December is going to look very similar. Angola, slight increase. Realistically, everything else is fairly similar. We did get some additional buying from Nigeria. We don't have prices yet, but we did get some additional movements. Angola and Congo were able to sell at a little bit higher premium versus the last week. So we do expect to see Nigeria. They did bring it down because they were way too high on a differential side, and that's likely found some buying, which again is going to put a little bit of support in that market. When you look at Europe, the builds have been fairly flat. We do expect this to start to grind higher. As you can see, seasonally speaking, we normally get a sizable bounce. That is something that we do see, especially as that Angolan crude, some of that Nigerian crude shows up. So realistically, when you look at Europe, they're buying from Libya, they're buying from CPC, they're buying from Nigeria, Angola, and the U.S. So again, they do have enough, and that's going to bump that a bit higher. When we look at storage, gas oil had a small build of 34. Gasoline had a small build of 3, which is the 3 is the big problem. Overall, gas oil, as you can see, still at a very low side, but that balancing act, the increase in rates, tightened the ARB. It's still open, but again, tightened the ARB coming from the U.S. into Europe. When we look at gasoline, again, seasonally adjusted all-time highs, blowing through numbers. This is going to be that huge problem that we talk about of how do they unleash that, because the market is facing something similar. We don't need this level of gasoline, and that's going to hinder how easily they can make some of that gas oil. Now, when we look at fuel oil, fuel oil volumes have continued to come down. That's trending closer to, it's obviously well below 22 in 2020, but again, trending to the downside, which is a lot of that is going to be some of that recracking that we've talked about. Fuel stockpiles in Singapore, on total, you can see they're just starting to trend up. We expect it to be sideways, and the reason why is that bifurcation between light distillate and middle distillate. So light distillate had a bounce. The only time it was higher was in 2020 and 2022. Not good comps. We do see that again continuing to trend up and putting some of those pressures into it in general. And then on the middle distillate side, you can see that big drop. So again, that's that problem where light distillate what's the crack? The crack spreads are weakening, but middle distillate, you had that nice drop in storage. That's going to keep things active, but the problem remains getting that middle distillate crude or that heavy the disty heavy crude and trying to manage those runs and that underlying portfolio. Here, resid, as we've seen, is just going to kind of be sideways. There's not a huge upward or downward movement on the heavy resid side. When you look at North Sea floating storage, with Brent being so much cheaper than Middle East, with that, the North Sea is going to continue to flow. We don't see that changing in the near term. And then when we pivot over to Europe, European floating storage slowed down, but we do have those cargoes coming in. That's going to help pivot this back up and just push us back towards that middle ground 5-year average. So that's what we have for you today on the EIA show. If you have any questions, please let us know. We'd love to hear from you, and we hope you enjoy the rest of your week. Thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.